I'm Bob Calling with Market Trader Tao, and today we're going to continue our series on chart patterns, and we're going to be talking about triangles. But the first thing we need to talk about is where we will expect to see a triangle on a chart. Now, the first thing we're going to do is we're going to talk about wave pattern and the what's called an impulse pattern and a corrective pattern. So let's get into that right now. Now, first of all, you see right here, we've got our base. That's the beginning of a basing pattern or a consolidation pattern. And then out of that, you're going to have a breakout right here, and then your trend is going to develop. Now, the first thing you want to do is when you draw a trend line is you draw your trend line off the bottom of the peaks. So that's the direction of your trend, and you use your trend line to establish the bottoms of the peaks in an upward trend. Now, on phase 2, when you start your upward trend, you're going to have a number of pullbacks. Those are technically called corrections. But they're also, during an upward phase, you're going to have what we call an impulse move coming up out of your base pattern, and an impulse move is with the direction of the trend. Now, typically, if you can imagine yourself sliding down one of those big old super slides. Now, when you go down that super slide, you're going to go with the direction of the trend. That's going to be a nice straight shot right to the bottom. But if you were going to try to turn around and walk up that slide, your path is not going to be as direct. Now, when you look at a chart, you can tell the difference between an impulse and a corrective wave just by the shape of the line that's being developed. Now, what you'll see here is a real rocky line. It's all over the place. It's up and down, back and forth. And what's happening here is that the buyers want to keep it going. The sellers want to sell off. And so what you do is you have this argument going on here, this disagreement for a short period of time, where many of the sellers are selling this impulse. They've reached the top, they bought in back down here, they reached the top, and they're selling that off. But at the same time, you've got new buyers coming in, trying to accumulate positions for this next impulse. Now, typically on an uptrend, you're going to have 1, 2, 3 impulse waves, and you're going to have 2 corrective cycles. And this is where, in these corrective cycles, is where you're going to see your triangles develop. And typically, if a triangle develops here, you won't see a triangle develop here. You'll usually have a triangle in one of the two, but not both. Most of the time, your triangle is going to develop on the second part, because what you're going to have is you're going to have people thinking they're at the top. Now, a triangle in an upward cycle is a continuation of that phase. In other words, you've got your first wave, then your second part. Well, your triangle is going to start on this, usually the second one, and that triangle will develop in an upward cycle on that impulse, and you'll start to have some pull back here, and then when the sellers are exhausted for this pullback, the buyers are going to start moving back in, and they're going to try to push this up a little bit more. And then what you're going to do is you're going to hit a resistance line where there's no more buyers right now. And the sellers will move back in and they'll move back down to a new level. And what you'll do is that once you've established this second corrective wave, you can start drawing a line from point A. A is always at the bottom of your first correction. And then you're going to have a B. And then down here you're going to have a C. Now, usually what will happen is you'll run out of buyers a little bit further, or you'll run out of sellers. There'll be less sellers going down, and the buyers will jump back in a little bit sooner, and they'll push it back up, and then you'll hit resistance again, and there's nobody above here that's willing to buy any higher than that, and so the sellers will move back in, and they'll push it back down. And then you'll have D. And then, once that happens, you'll come back to E. So you'll have A, C, E, and you'll have D, B, and D. Now once you have this complete cycle, then you'll have usually what's known as a breakout. You'll have a breakout right here. Now typically on a upward trend, when you develop a triangle, the breakout is going to continue this way, and when you have your apex of your triangle out here, your breakout is going to continue on up to the top, and those breakouts are usually very quick, very fast, and they move very quickly. Most of the time, most professional traders don't trade the triangles. What they do is they'll trade up to here, and they either one of two things. They'll sit out the triangle, or they will wait until the breakout and buy that breakout. And that usually will take you up higher, typically the width of the triangle. And that's pretty much how triangles work. Now there's a lot of different kinds of triangles, and we probably don't have enough time in this video to discuss the number of triangles that we have here, but it's very important that you get the gist of a triangle. Now typically when you have an upward trend like this, the triangle will actually be pointing down more. It will be it will look very much like this, and then you'll have your upward movement. But it's very important that you get the concept of triangles. Now typically triangles, a continuation triangle, they happen in your uptrends and also your downtrends, but they look differently. And in our next series, we'll talk about the different kinds of triangles that are there. But for now, that's a triangle.